Trading on margin and leverage. When you trade on margin, you don't trade with the money in your account. Rather, you're trading with money that you borrow from your broker. Your account then acts like a deposit to secure the trade, and the amount the trade either gains or loses is either added to or subtracted from your account balance.
Traders use leverage on a trade to increase the gain or loss on a trade. Without using leverage, often the exchange rates do not change enough to make trading worthwhile. By amplifying the trading with leverage, the trader could turn a very small move in exchange rates into a large profit or loss on the account.
Let's say there's a trader with a $10,000 account, and he decides to trade one mini lot worth of currency on the British Pound USD pair. Now the trader borrows $10,000 worth of currency and exchanges it for the British Pound. Now what he's done is he's borrowed $10,000 worth of currency with an account balance of $10,000. He's not trading with his own money, he's still trading with the broker's money, even though the account balance is the same amount. So since his position size is the same size as the amount in his account, his leverage is 1 to 1. Remember, the leverage is always a ratio of the amount of currency that a trader is trading in ratio to the size of his account balance. Now let's say the trader, instead of buying just one mini lot, had decided to buy 2 mini lots, or perhaps added a second mini lot later. He now holds a position size of $20,000 worth of currency, with his account balance still being only $10,000. He has borrowed $20,000 from his broker. And so his leverage is now 2 to 1 because he's got twice as much, he has a position size of twice as much currency as the balance in his account. Okay, let's say instead of just buying 1 or 2 lots, the trader decided to borrow a lot of currency to try to capitalize on a very small move in the exchange rate in a very short period of time. So what the trader does instead this time is he borrows $100,000 worth of currency. Now his account size is still $10,000, but he's borrowed $100,000. So his leverage is 10 to 1. He holds a position size that's 10 times as big as the size of his account. Leverage is always the total position size of all positions versus the account balance. So let's say a trader decided to buy 1 lot on one currency, like for instance the euro-dollar pair, and 2 lots on another currency, for instance the dollar-yen pair. They would still have a total position size of $30,000 of 3 mini lots versus a $10,000 account, so their leverage would be 3 to 1. On a standard trading account, most brokers will offer 100 to 1 leverage, meaning they'll allow you to borrow 100 times your account balance and trade it. With a $10,000 account, you can trade up to $1 million worth of currency. On a micro account, most brokers will offer 400 to 1 leverage, meaning they'll allow you to borrow 400 times your account balance and trade with that. Usually new traders hear this and immediately think of large rewards. But one must remember that leverage is a two-way road. Larger position sizes can amplify your gains, but they can also amplify your losses. And large position sizes is the #1 reason new traders lose money. When a trader places a trade, a portion of their account is placed on hold for each lot of currency that they are trading with. So let's say a trader has an account balance of $10,000 and decides to buy 1 mini lot of currency. $50 of his account is then placed on hold, and that is what's known as his used margin. He still has $9,950 available for him to trade. Now let's say he increases that position size to 2 mini lots. He now has a position size of $20,000 worth of currency. He's used $100 worth of his margin. He still has $9,900 he can trade with. If the trader decides to take a rather large position and buy 20 lots, he has now obtained $200,000 worth of currency to trade with. $1,000 of his account is placed on hold, and that is his used margin, and he still has $9,000 left to trade. As you can see, this account has a 200 to 1 leverage on it, which, as you're probably beginning to see, allows you to take position sizes that are much larger than anyone should possibly take.
So that's a basic overview of trading on margin and leverage, a system that allows a trader to borrow money from the broker and trade position sizes much larger than their account balance to amplify the trade.